It's been a volatile and rather confusing week for Palantir Technologies, the U.S. data analytics and artificial intelligence firm often hailed as one of the early winners of the AI boom. Despite reporting stronger than expected third-quarter earnings, Palantir's stock tumbled sharply down around 14% for the week, making it one of the weakest performers on the S&P 500. Let us break down what happened, why the stock fell despite positive results, and what it means going forward. Palantir reported Q3 revenue of about $1.18 billion, up more than analysts expected. Earnings per share came in at 21 cents, also beating estimates of around 17 cents. On paper, this should have been a solid win. Growth in both its government contracts and commercial AI platform sales continued, with the company emphasizing strong adoption of its artificial intelligence platform AIP among enterprise clients. But the stock reaction told a different story. Shares dropped sharply after the earnings call. Many investors were puzzled. How does a stock fall after beating earnings? The answer lies in expectations, valuations, and risk sentiment. Analysts and investors are increasingly worried that Palantir's stock has become too expensive for its own good. The company trades at a steep premium both on a price-to-sales and forward price-to-earnings basis compared with other tech peers. That means it's priced for near-flawless execution. Even a hint of slower growth or uncertainty can spark outsized selling pressure. Analysts at RBC Capital Markets put it bluntly. They said Palantir's valuation looks unsustainable and maintained an underperform rating with a price target around 45 per share, notably below where it had been trading before the drop. Adding fuel to the fire, reports emerged that prominent contrarian investor Michael Burry, known for predicting the 2008 housing crash, had placed put options against Palantir. That means he's effectively betting the stock could fall. While the scale and timing of those puts aren't fully known, the psychological effect was powerful. It reinforced a growing narrative that Palantir might be the next high flyer in the AI space to come back down to earth, just as investor enthusiasm begins to cool off. Another factor behind this week's sell-off is concern about government spending cuts, particularly in the defense sector. Reports surfaced that the U.S. Pentagon may trim or delay parts of its technology and defense budgets, an area where Palantir is heavily involved. Government contracts still make up a large share of Palantir's revenue base. Any slowdown in defense or intelligence spending directly impacts the company's growth trajectory. This week, headlines about Pentagon belt-tightening spooked investors, pushing the stock even lower. And there's yet another wrinkle. Palantir also made news for a lawsuit filed against several former engineers, accusing them of stealing trade secrets to form a competing startup called Percepta AI. Palantir claims the ex-employees used insider knowledge to build what it calls a copycat AI platform. While the case